Yo, what's the cap rate? If you're a real estate professional or an aspiring real estate investor, you've likely heard this before. The capitalization rate, or cap rate, is one of the most common ways to quickly assess a property's value, as it indicates the rate of return that an investment is expected to generate. It's a pretty simple calculation. Cap rate equals the net operating income divided by property value. Now, the net operating income represents the income generated by the property after first deducting operating expenses, but before mortgage payments or income taxes are deducted. A quick example: if a property is producing $200,000 in income annually, but has $100,000 in operating expenses over that same time period, the NOI would be equal to $100,000. If a seller wanted $1 million for that property, you would take the $100,000 divided by $1 million, and boom, the cap rate is 10%. In this environment, that could be a deal. Now, if that same seller wanted $3 million, we do our calculation again, and the cap rate falls below 4%, which doesn't really seem to be that attractive. So you can see a quick way to determine the value that you place on the property based on the returns that you are looking for is to use a cap rate calculation. This becomes a little bit more complex when you start thinking about what cap rate to buy versus what cap rate you want to sell at. So if you have more questions, reach out to us at LaRock Capital.